Section 1. The imperative of options. Why understand? The world of finance, much like life itself, is fraught with uncertainty. We make decisions based on incomplete information, often swayed by emotions and biases. In such a world, understanding the tools at our disposal becomes paramount. Options, often seen as complex and risky, are one such tool. They offer a unique way to navigate the vagaries of the market, providing both opportunity and peril. To dismiss options as mere speculation is to ignore their potential. They are not simply tools for gamblers but instruments of risk management, income generation, and strategic portfolio allocation. Like any tool, their effectiveness depends on the skill of the user. A thorough understanding of their mechanics, risks, and potential rewards is crucial for anyone venturing into this domain. Just as a ship's captain must learn to navigate using the stars, so too must an investor learn to navigate the market using options. Section 2. Cash-secured puts. A calculated gamble. Let's delve into the specifics, starting with cash-secured puts. This strategy involves selling a put option, granting the buyer the right to sell you shares of a specific stock at a predetermined price, the strike price, before a certain date, the expiration date. In return for this obligation, you receive a premium upfront. The cash-secured part is crucial. You must have enough cash in your account to purchase the shares if the put option is exercised. Essentially, you are betting that the stock price will stay above the strike price. If it does, the option expires worthless, and you keep the premium. However, if the stock price falls below the strike price, you are obligated to buy the shares at the higher strike price. The key takeaway here is that selling cash-secured puts is a strategy for investors who are bullish to neutral on a particular stock. Section 3. Covered calls. Prudence, but at what cost? Now let's turn our attention to covered calls. This strategy involves selling a call option while simultaneously owning the underlying stock. By selling a call, you grant the buyer the right to purchase your shares at the strike price before the expiration date. In return, you receive a premium. The covered aspect is essential. You must own the underlying shares to cover your obligation if the call option is exercised. This strategy is often employed by investors who are bullish to neutral on a stock but are willing to sell their shares at a predetermined price. If the stock price stays below the strike price, the option expires worthless, and you keep the premium, effectively reducing your cost basis for the shares. However, if the stock price rises above the strike price, your shares will be called away, limiting your potential profit. Covered calls allow you to generate income on your existing stock holdings while limiting potential losses. Section 4. The wheel in motion. Combining strategies. The wheel option strategy combines cash-secured puts and covered calls to create a cyclical approach to generating income and potentially acquiring stocks at favorable prices. It's like a wheel, constantly turning, with each rotation offering a new opportunity. The process begins with selling a cash-secured put on a stock you are bullish on. If the put expires worthless, you keep the premium and repeat the process. If the put is assigned, you buy the shares at the strike price. Now you own the shares, and the wheel continues. You sell covered calls against your stock position, generating more premium income. This continuous cycle of selling puts and calls aims to generate consistent income while benefiting from the power of compounding. Each successful rotation of the wheel adds to your profits, which can then be reinvested to further accelerate your returns. Section 5. Advantages of the wheel. Navigate with care. The allure of the wheel strategy lies in its potential to generate consistent income. By selling options, you are essentially collecting rent on your capital. This can be particularly appealing in volatile markets, where price fluctuations can create opportunities to profit from time decay. Moreover, the wheel strategy offers a disciplined approach to investing. It forces you to identify stocks you are bullish on and to establish clear entry and exit points. This can help to reduce impulsive trading decisions and promote a more systematic approach to portfolio management. The strategy also provides a degree of flexibility. You can adjust the strike prices and expiration dates of your options to align with your risk tolerance and market outlook. Section 6. Disadvantages of the wheel. The price of complacency. Despite its allure, the wheel strategy is not without its drawbacks. One of the most significant risks is the potential for unlimited losses when selling puts. If the stock price plummets, your losses could exceed the premium received. Another risk is opportunity cost. By selling covered calls, you are limiting your potential upside if the stock price surges. You will miss out on significant gains if the stock experiences a rapid price appreciation. The wheel strategy also requires a considerable time commitment. You need to constantly monitor your positions, adjust your strikes and expirations, and manage assignments. Furthermore, the success of the wheel strategy depends heavily on selecting the right stocks. Section 7. Market conditions. When the wheel spins best. The wheel strategy is not a one-size-fits-all approach. Its effectiveness depends largely on the prevailing market conditions. Understanding when to implement and when to refrain from using this strategy is key to maximizing its potential. The wheel strategy tends to perform well in neutral to slightly bullish markets. In such environments, volatility is often subdued, allowing you to collect premiums without experiencing significant price swings. This stability provides a favorable backdrop for the strategy to generate consistent income. However, the wheel strategy can be risky in bearish markets. As stock prices decline, the likelihood of your put options being assigned increases, potentially leading to significant losses. Therefore, it's crucial to assess the market conditions carefully before implementing the wheel strategy. Section 8. Risk management, the guardian of your portfolio. Navigating the world of options requires a disciplined approach to risk management. This is especially true for the wheel strategy, which involves selling options and taking on potential obligations. Proper risk management is not about eliminating risk altogether, but rather about understanding and mitigating it. One crucial aspect of risk management is position sizing. Never allocate more capital to a single trade than you can afford to lose. Diversifying your portfolio across different stocks and sectors can further mitigate risk. Another essential element is setting stop-loss orders. These orders automatically sell your position if the stock price drops to a predetermined level, limiting your potential losses. While stop-loss orders cannot eliminate risk entirely, they can help you manage it more effectively. Section 9. Advanced techniques, fine-tuning your approach. Once you have a firm grasp of the basic principles of the wheel strategy, you can explore advanced techniques to further enhance your returns and manage your risk. These techniques allow you to tailor the strategy to your specific risk tolerance and market outlook. One such technique is rolling your options. This involves closing your existing position and simultaneously opening a new position with a different strike price or expiration date. Rolling can be used to extend the duration of your trades, reduce your risk, or adjust to changing market conditions. Another advanced technique is using spreads. Spreads involve simultaneously buying and selling options with different strike prices or expiration dates. This can help you reduce your maximum loss or enhance your potential profit, depending on the type of spread you use. Remember, these advanced techniques require a deeper understanding of options trading, and should only be attempted after gaining sufficient experience. Section 10. The psychology of the wheel. Patience is a virtue. Trading, like many endeavors in life, is as much a psychological game as it is a technical one. The wheel strategy, with its emphasis on patience and discipline, requires a particular mindset to execute effectively. Greed and fear, two of the most potent emotions in trading, can lead to costly mistakes. Greed can tempt you to hold on to positions for too long, hoping for larger profits, while fear can cause you to exit trades prematurely, locking in small losses. The key to successful wheel trading is to approach it with a calm and rational mindset. Don't let emotions dictate your trading decisions. Stick to your plan, manage your risk, and be patient. Remember, the wheel strategy is not a get-rich-quick scheme. It requires patience, discipline, and a willingness to stick with the strategy through ups and downs. Section 11. Conclusion. Navigate the options market with wisdom. The world of options trading can seem daunting, but like any complex system, it can be understood with careful study and practice. The wheel strategy, while not without its risks, offers a compelling approach to generating income and participating in the market. Remember, the key to success in options trading lies not in predicting the future, but in understanding and managing risk. The wheel strategy, with its emphasis on selling options and collecting premiums, provides a framework for doing just that. As you embark on your options trading journey, remember the words of the ancient Stoic philosopher Seneca. Luck is what happens when preparation meets opportunity. By thoroughly understanding the mechanics of options, diligently managing your risk, and patiently executing your strategy, you can position yourself to capitalize on the opportunities that the market presents. The wheel strategy is not a magic formula, but a tool that, when used wisely, can help you achieve your financial goals. Approach it with respect, diligence, and a healthy dose of caution, and you'll be well on your way to navigating the exciting and potentially lucrative world of options trading.